Welcome to the Retiring Real Estate Investor podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. All right. Hello, everybody. Welcome to the Retiring Real Estate Investor podcast. I'm your host, Brandon Bruckman, with our other host, Joshua Wright. And today we're going to be discussing how things got started. We're calling these insight origin stories of how this little thing came together. That's turning into a bigger thing very fast. So I wanted to start, Josh. Good morning, good afternoon. How are you?
I'm great. To kick us off, I just want to point out our lovely coffee mug signifying the Chiefs Super Bowl win of last season. Just want to throw that out there.
Yes.
Thank you.
For those that don't know, Josh is in Kansas City, Kansas or Missouri?
Kansas side. I'm over here in God's country. Come on.
And I'm in Milwaukee, Wisconsin, and our representative sports team, since we've known each other, I believe the count is 3 championships in Kansas City to 1 in Milwaukee/Wisconsin. Is that the current scoreboard?
I'd say that's accurate.
Yeah, I don't think you even know how many Milwaukee, Wisconsin championships in there.
4-1. I think it's 4-1.
How many do the Chiefs have?
I think we've got 5. We've got 2 Super Bowls, 5 AFC championships.
Oh, those don't count.
All in the last. Oh, those don't count. Okay.
No, the whole
three appearances, 2 wins.
The whole thing. No, we don't count. We count the whole thing, man. Not the first loser. We count all of them.
Okay.
Yeah, exactly. Right. There's winners and losers in this contest. So someday maybe we'll catch up. It's not looking great, but we have some chances here. So, Josh, today I wanted to talk about. Tell us how you got started. I think it's fascinating to learn about your background. It's something obviously that clients ask us about all the time. But how did you get here? Where was the start?
Sure. So basically, I went to school to be a portfolio manager. When I was in college, I went down the route of financial analysis. Thought I was going to work on Wall Street one day, manage a fund, do something like that. And I got late in my college career and kind of realized I didn't want to do that. I wanted to be in front of clients more often than anything else. And so I kind of pivoted last minute, came out of school, went out to become a financial advisor, worked for a big wirehouse firm, and began to build a financial planning and investment management business. And actually that's what I've been doing for 20 years. However, through that, I grew up in the real estate business. So my father and grandfather owned basically roadside motels, 2-lane highway, Best Westerns, Comfort Inns, that sort of thing. And I grew up working in that business, and it kind of ended up forcing me into the real estate space, so to speak, years later. So 5 boys in my family. Every boy had to start working in the motels at age 12, which I don't think you can get away with today. But we all started working in the motels, doing the most disgusting jobs you can imagine. My first job at the hotel, my dad had 2 motels in the hometown I grew up in. He also had a Texaco gas station, all on one corner of town, 2 motels, 1 gas station. And I rode my bike to work. Took me 40 minutes to get there. And I walk in the front door, super excited to go to work. And my dad says, "All right, take this razor blade and I want you to go out and scrape the gum off the concrete." I thought he meant out front of just the motel where his office was. And he said, "No, I want you to do this whole property. When you're done, I then want you to go across the street and do the next property. And when you're done with that, I want you to go over to the gas station and take care of that property. And it basically took me 6 days, 5 to 6 days on my hands and knees. And that was my first entree into real estate. By the time I was driving in high school, he was having me go unclog toilets at 2 in the morning out of the hotel. Basically, I'll put it this way. By the time I left for college, I told my dad I would go to college so I never had to work in real estate again. And here we are, 20 years later, the largest part of our business is focused on real estate. So that was kind of how I ended up in the financial space in general. The real estate space in particular was really just a sideline. So my father, really my first year in the business, he got an unsolicited offer for one of his motels for $1 million. He wasn't ready to retire yet. He was probably 8 years, 9 years out of retirement, but he said, I don't want to go buy another property and have to staff it up and manage it. He said, I want you to come with me, meet with my CPA. I went along to that meeting, and CPA said, you're basically going to pay about 40%, give or take, in taxes if you don't do a 1031 exchange. And my father said, well, I'm not going to do that. I definitely want to exchange. I'm not going to pay the tax bill. That's crazy. His words, that's basically like giving half my money away day one of retirement to taxes. And that's crazy. So he looked at me and he said, go find me something passive to exchange to. And I looked at him and I said, that's not what I do. I'm in investment management, financial planning. He's like, I don't care. Go figure it out. And sure enough, that's what I did. That kind of started my whole journey down the 1031 exchange path, figuring out what passive real estate deal structures were out there. And, the rest is history.
But we're not on our hands and knees scraping any gum off the concrete. So at least there's that.
Not anymore.
Not anymore. Return to that. Let's go back to when let's break this apart a little. Let's go back to when you graduated college. You graduated college, K-State, and then you went right to Phoenix, correct? And then how did you start your business in Phoenix?
Yeah, so I did something that a lot of dumb 23-year-old kids don't think about. I said, I want to get into the, investment management, financial planning business. And I moved from Manhattan, Kansas, where I went to college, to Phoenix, Arizona, to a city where I didn't know a single soul, to start a relationship-based business. Makes no sense, right? My fiance and I, my wife now, she was a fiance at the time, we moved out there together. I hooked up with a big wirehouse firm. There was actually a K-Stater in that office. That's how I found that office. And I went in there. I had just gotten my securities license. I had studied for 2 months to get this license. My funny story with that, these tests are a pass-fail, okay? You need a minimum number to essentially get your license, period. I studied like crazy. I placed in the 94th percentile, something like that. I walk in day one of my new job to tell my boss that I got in the 94th percentile. He looked at me and he goes, well, what the hell did you do that for? So what do you mean? He goes, I don't care whether you got a 94% or a 70. You only need a 70 to work here. You should have just studied hard enough to get a 70. That's literally what he said. And I was just completely dejected. I was like, oh my God, what did I do? But anyways, so I started my practice there. I literally spent the first year and a half just pounding the pavement, trying to build relationships, build clients. At that time, not a lot of people like to do business and give money to a 23-year-old. I couldn't get people to meet with me unless I played golf. And as you know, in Phoenix, everybody plays golf. So I began to play golf 4 days a week, and that's how I got people to meet me and began to build relationships that way. But began to build my practice. But I'm from Kansas City originally, or near Kansas City. So I was building more clients in Kansas City than I was in Phoenix at the time. So after about a year, give or take, I told my wife we need to move back. This is where my business is growing. And I found a senior advisor, a really experienced advisor here in Kansas City, partnered up with him, and moved back and began to build my business here in Kansas City. Funny enough, after I left Phoenix, I had kept a handful of good clients I had built there. They began to refer me clients. And so I started going back to Phoenix at least twice a year. And before I knew it, I had built a really large practice in Phoenix. And from there, while simultaneously while building Kansas City in the Midwest. And then apparently nobody's from Phoenix. They were all from Southern California because everybody in Phoenix started referring me family members in Southern California. So I began to go to San Diego quite a bit, opened an office there as well. And then the rest was history. Now we have a big practice down the west, West Coast, Phoenix areas. And then of course now we're all over the country. But that's kind of how I ended up in Kansas City.
Correct me if I'm wrong, though. In Phoenix, when you say pound the pavement, I think you understate what you were doing. You were going door to door, correct?
Yeah, I was doing everything. I was going door to door. I was doing fairs, teachers' fairs, employee fairs. I mean, I would present and go anywhere that anybody would let me in the door. I mean, it was it was tough. I basically would be out the door at 7 a.m. I would get home at 9 p.m. If I didn't have enough meetings in a day, I just kept making phone calls. I stayed there until I got enough meetings to survive, essentially. And it was survival at that point. I mean, truly. There was no salary, there was no stipend. It was you eat what you kill, basically. And if you don't make it, you're not eating. So I always tell people, my wife at the time, she worked a job that was basically from 2 in the afternoon till about midnight. So my whole first year was me leaving in the morning while she was asleep. Then when she would come home, I would be asleep. We worked 6 days a week. The only day we both took off was Sundays. So we never saw each other really. Sometimes we didn't communicate more than two sentences for 6 days. And on the seventh day, we would both take Sundays off. And all we could afford to do basically was go to Einstein's Bagels and have a bagel and coffee and, catch up on the week. So, yeah, that was the beginning. It was a tough road, but learned a lot for sure.
All you youngsters out there, did you hear all that? It's a real sacrifice to build something for yourself, and that's independent of others. It takes a lot. So all right, so we're back in Kansas City. When did
Ooh. Let
no,
me
go ahead.
let me give one more
Please,
story.
sorry.
Let me give one more story here for how tough this road can be. When I was going to leave Phoenix and move back to Kansas City, and I found the senior advisor that I wanted to partner with. My whole goal was to find an older advisor, successful person who could basically show me and teach me everything that I didn't know about the business, and there was plenty of that. But who also was thinking about retiring within 5 years or so, and I could buy their practice from them and grow it. Well, when I flew back to Kansas City, I interviewed with this guy, and it went great. We had a couple phone calls. He said, "I'm going to hire you. I'm going to bring you on board." Great, teed up, ready to go. When I moved back to Kansas City, I come into the office for my first day of work, and there was another guy at the office in my job role when I get there. So I go into the senior advisor who hired me, and I said, "What the hell is going on?" And he goes, "Well, this other guy came in, and he just seemed like a good fit, and I'm not going to give you all the great details, but all I'm going to say is I told him at this point, again, no salary. I need to survive. So I looked at him and I said, "Listen, I'm going to work harder than that guy. I will make your coffee every day and bring it to you if you will just take me into every meeting that you have with a client for the next 12 months. I won't say a word unless you ask me to talk. I just want to learn. I will work. I'll do anything you want me to do. I'll do your financial plans. I'll whatever you want. Just teach me." And so he said, "All right." So he kept me on board along with this other guy. Needless to say, 6 months later, that other guy was gone. And within about 6 to 9 months, he started asking me, lo and behold, asking me questions in front of clients and then asking me to start presenting a little bit. And that's really how I learned how to present in front of clients. But, that's the lesson there for young people coming up. I mean, I literally made this guy's coffee every day and took it to him. I didn't care. I would do anything. And that paid off, obviously. Here we are 20 years later, but you don't hear those stories very often today.
No, not anymore. As we sit here in our back when I was a kid conversation, right? Oh boy, sound like my parents. That's phenomenal. I didn't know that. I didn't know that story. I wanted you to kind of bridge the timeline a little bit for me, and I don't think I know this either. You're going through this advisor experience timeline. When does the hotel when is it that your dad splices in there and goes, "Hey, I want to sell some of these hotels"? Were you back in Kansas City?
So that happened in my second year in the business. I had
Oh,
just moved back to Kansas City. So I was wet behind the ears. When I went to that meeting with him, I mean, I didn't know anything, truly. Not to mention, I wasn't in the real estate business. so, but so that was probably year two. From there, that opened my eyes to the fact that there was this need for people like him, retiring real estate investors, people who were coming out of real estate who didn't want to manage real estate but had a tax problem. So that led me down the path to start exploring what passive structures are out there. That's when I started getting educated on tenant and common structures. The DST came out right after that first sale that my dad did. So he sold before the DST was available, but the IRS ruling in 2004 came out right after that. And I saw the DST structure at that time, and we've talked about this in another podcast, but I saw the structure. I wasn't confident that this thing was going to be around forever. I wanted to see that it was upheld in IRS audits, in court, et cetera, et cetera. And so over the next, let's call it 10 years or so, I had clients that had real estate we looked at, and we did just a few 1031 exchanges here or there, but I didn't make it a large part of the business at all, really. And then as I got later past that 10 years, these needs kept popping up more and more and more. In that same time frame, my grandpa sold all of his real estate off. My dad began to sell his real estate off. I had clients who owned farmland who were looking at selling their farmland. And so this need just kept popping up. And it was from those experiences that eventually, when I parted ways with that old partner and started my own firm, that's when I decided to make 1031 exchange and passive real estate a major part of our business at that point. So that was kind of the timeline in there, but it was a long timeline. DSTs took a while to cook. I wanted to know those things were really going to be a legit option for clients. So about the time I left and started my own firm, it was perfect timing that we had TIC options, we had DST options. The world was getting more used to this retiring real estate investor need. We had a lot of boomers who were starting to retire and still are selling real estate. So, that's kind of how it progressed.
gotcha. Okay, so that makes a ton of sense. So there's a timeline. I think there's another milestone in here that I definitely want to hit along the timeline. Is you went from, it seems like you went pretty quickly from wet behind the ears to now you're presenting in front of clients. But further than that, you're actually when I met you, you were running in essence, the investment strategy of that shop. What was the evolution of that on the investing side of the equation to kind of take you to the point where, in essence, you were the chief investment officer of that firm?
Yeah. So my mentor partner, the gentleman that I came into business with when I got back to Kansas City, he was an old school sales guy. He never managed money on his own. He was a sales guy. He was a great relationship guy. Had great relationships with his clients. This is 03, 04, 05 as we're starting to build the firm, and I'm taking a much more active role. I am one of those people who, always questioned. I question everything. Let's put it that way. I don't want to say I challenge authority per se,
Maybe a little,
but
maybe a little.
I don't like being told what to do. What can I say? But everything let's put it this way: everything I was taught in college for portfolio management was basically modern portfolio theory. It was the whole idea of the pie chart. So much goes in international, so much goes in U.S. stocks, so much in bonds, and we're basing the weightings on historical returns and volatility for these asset classes, and you diversify that way, and that's how you manage risk, and you do a rebalance once a quarter, and that's pretty much it. And that's how 95% of the world was, and that's what I was taught in school. Well, while I was in school, I got in trouble quite a bit because I would ask questions during those classes like, well, if I'm doing this for a client, how do I know when I'm wrong? It's a pretty common sense question, right? Like, how much money do I have to lose before we decide I'm wrong? We're doing all this research to make a decision as to what to buy for a client in the portfolio. how do I know when to sell it? How do I know when I'm wrong? Is it when they lose 10%? Is it when they lose 50%? I don't know. And I got no answer. I essentially got told to shut up and quit asking these questions. And so when I came into the business, it was right as the worst of the tech bubble was blowing up in the stock market. And so I started out doing modern portfolio theory with clients in that 02, 03, 04, 05 timeframe. And right as I'm starting my business, people have just come out of 2 years of down years and they're in a third year of down year. Okay. So it was a really tough time. When I was working with my new kind of business partner, I'll call him my new mentor at that time, he was still doing old school stuff. And, I saw these clients' financial plans like not working. Essentially, they had lost so much money through that blow up that it was taking so long to get that money back, assuming they didn't sell at the bottom, that I just saw some problems in that system. In my view, I was uncomfortable with that approach. And so leading into 2008, before we had '08 happen, I began to do research on what other investment strategies are out there with one premise in the back of my mind: how do I manage risk? I'm not worried about return. Like, how do I keep people from losing a bunch of money ultimately? And so while still giving them liquidity and keeping fees low if I can. And again, this is back pre fee-based management days. This is all commission days. Back when people were paying 5.75% to buy an A share of a mutual fund right up front, right? So you're down almost 6% day one, right? So basically what I did is I reverse engineered. I looked at all other strategies that I was taught in school. None of them really dealt with risk management well. I then did something I read in the back of Michael Covel's trend following book, where he had all these charts of basically returns of private equity shops and famous investors, people in there who had even made their money investing their own money, not client money. The weird thing about being a financial advisor is you get judged on how many clients you have and how much assets you manage, neither of which has anything to do with whether your client made money. So I basically went and pulled similar lists to what he did. I went and found the top 20 earners on Wall Street, but people who were making their money managing their own money, or at least started that way. And I said, what are they doing? And guess what? None of the top 20 did what I was taught in school. None of the top 30 did what I was taught in school. And after 30, I quit looking. I was like, okay, well, what are these guys doing? And they were doing basically trend following at that point, or a version of trend following. So I started to reverse engineer their strategies and tried to simplify it down, make it something I could do for clients and build my own strategy around that, all with the idea of focusing on keeping losses small, letting your winners run in your investments, but keep your losses small, simply because for a financial plan to work for a client, or I'll say it another way, what blows up a financial plan is too many losing years in a row of return, or too large of loss. And the problem with a large loss is not that you can't get it back, it's how long it takes to get it back. And we have a finite amount of time to invest before we retire and live on that money. So regardless, I built this strategy leading into '08. I started running it with my own money prior to '08. And then right around the beginning of '08, we started to implement it for clients. And timing could not have been better, because in the strategy that I run, and we still run to this day, which you're very familiar with, it is a risk on, risk off strategy where we will come out of the markets, not completely, but mostly, and we will de-risk a portfolio. And we de-risked our portfolios by middle of '08, and we actually were out of the market for 18 months through '08 into '09. And I won't say every single client was in this strategy yet. We were in the process of migrating clients, because you're still presenting to a client, you're still making sure that they're comfortable and they're making the decision. But for those clients that were in that strategy, they didn't lose money; they made money through that time frame. And it kind of sparked the direction of how we've managed money ever since, which actually is how I met you, was part of that process.
How did you first find the Covel books? I don't think I ever asked you this.
That's a great question. I'm pretty sure I found his book by accident at a not a Barnes and Noble. What was the other big bookstore that was around back then? Remember the name of that? Borders. It was at Borders. Yeah,
Shout,
man, we're aging ourselves here.
shout out to Michael Covel is the common kind of
Yeah,
connection here, and shout out to Borders for being around. A lot of this is based around like
it was a pure accident, to be honest with you, to find that book.
it's so funny because, and we'll eventually I'll tell my story too, but that's sort of the common connection between us is questioning what we see in front of us and that natural curiosity. And I was making the same questions, except in a different environment where I shouldn't be questioning risk management. I shouldn't be questioning absolute returns in a hedge fund type environment, but I was, and I was getting the same sort of responses you were getting in academia. Was, go be quiet and back to your corner, please. And that wasn't an acceptable answer, um, unfortunately. So it's very interesting. So yeah, we'll send this to Michael Covel so you can listen to and give him a
I'll
pat on
tell
the
you
back.
what,
Great stuff. Honestly,
I I
the book's in the
devoured
background right
I
there.
devoured
If
this.
people are looking for it, there's trend following in the background if you're watching on video. Definitely read these books. They're mind blowing. Sorry, what were you gonna say, Josh?
I devoured his
Yeah,
book. You know, people today who weren't in this space back then wouldn't realize. We didn't have social media. It wasn't as easy to find information like this. So you had to get it through books and then make connections to get to these people.
yeah.
Um, and if you weren't in the space or you didn't have somebody telling you what books you should go check out, you know, you're like me. I mean, you literally, I just was looking at the investment book section every day, every time I was in a bookstore until I started finding stuff I identified with. But you had to read a lot of stuff to find the stuff you identified with. But when I found that book, for me, it was just common sense. It felt very common sense. Everything was clicking. It was remove ego from the situation. Just how do I, if my client needs X to make their financial plan work, how can I get them there as safely as I can while giving them the most liquidity and the lowest fees I can? Yeah, just simple, right? So yeah, that was a great one. Thanks, Michael. I appreciate it.
Okay, right. I think I read. There's a variety of books there. I think I read Turtle Trader in about a day and a half. Um, it's just it, man. It was just the end. Same experience. It was just the end when I read it. Once you watch people being successful, the people being successful is the validation of the strategy, and then you put it in play yourself. You're like, see, look at how this works, and we could talk endlessly about the case studies of how it works, even works now, and how the strategy is working today. Is a really good thing that we continue to see. I think this is a kind of vibe though that runs through our entire shop though, because I think we take a lot of this curiosity and challenging to the real estate space as well. When we look at,
Mm-hmm.
and we'll do a whole episode on DST due diligence. But when we look at all the real estate or alternative investments we have too outside the trading system, it's with that same very curious, some may even say pessimistic lens, and trying to map out the worst case scenario. And I've definitely been accused of being quote unquote one of those guys that is looking for what's wrong. Um, that's our job, right? Is to kind of peek at what's going to go
Yeah.
wrong here and try to avoid it the best we can.
Well, a key thing in there for us and the way we run our shop is it's the investments process we use is rules based. Okay, we have a set of rules. The beauty of rules and the data that we base those rules on is we can backtest on it. It's historical. We can look at actual data. Well, we've carried that rules based approach over to the real estate business that we run as well. We have a set of things we're always going to look at in every real estate deal. Um, but I absolutely agree that that curious mind. Um, I say these DST sponsors, real estate sponsors, hate us or love us, and those that hate us because we keep asking questions and we ask for a lot of information. But it stems back to how do I keep my client from losing a lot of money? Ultimately, I always tell clients your results are often dictated in an investment not by how much money you made on the upside, but how much you didn't lose on the downside. You know, My favorite line I tell clients on the investment side of our business is, you'll never hear an investment person tell you this, but your result is driven by what you paid for something and what you sold it at,
Mhm.
not not by all the information, all the research you did in the front end. As much as we do that stuff and we think it's important, if I paid 10 and I sold at 5, I lost money. How do I protect you in that scenario? Which is why we spend so much time on risk management. And we're not perfect, by the way. I mean, this is not like the most perfect strategy out there, but it is a process, both from the investment side and the real estate side. And that's why we talk so much with clients about kind of our view, our philosophy, if you will, our value system around investments, around real estate, because it drives how we make decisions around those. And if clients can identify with that, that's why they love it. It's a good fit. And I don't pretend everybody's a perfect fit, because they're not. We would rather we figure that out in the front end um, than the back end.
Yeah.
But anyways, maybe we should pivot this conversation off of me and talk about your origin story a little bit.
Should we? I don't know if we
Yeah,
have.
absolutely.
I don't know if we have time.
Well, we'll save that for the next time.
Yeah,
But
sort of out of
I
time.
do want to point something out.
Mhm.
Right back here, I have a Travis Kelce and a Patrick Mahomes bobblehead still in the box. And I'm thinking I'm going to keep these suckers in the box because they're going to be worth money one day.
We wish your football team all the success in the world. Congratulations. Hate you guys. We don't hate
I'm going to
you.
get a tiger and a Phil Mickelson right next to him.
We're jealous of your success. We're jealous of your success. You'll come back for us. This is good, man. I'm trying to think what else I want to say. Pugs. You want to talk about pugs?
Pugs?
Yeah, this is an important part of Josh Wright is the dog situation,
dog?
the pug rescue situation. I think it's an important part of who you are, isn't it?
Well, yeah. I mean, I love dogs.
Where's the pug? Is it in the house right now? Is it sleeping in that chair behind you?
She's not in the chair over here.
Oh,
She is downstairs with my wife at the moment. Yes, I have a pug who I rescued as a puppy. We have rescued Boston Terriers, my wife and I, the whole time we've been together, which is 21 years now. I think we've rescued 3 or 4 Boston Terriers. We actually had, coming into the pandemic, we had 2 Bostons, which we had rescued years ago. They were 14 and 16. And we had rescued the pug puppy about 2016 because we thought our oldest Boston was going to pass away. And we wanted to make sure the other Boston had a sibling because she never not had a sibling. And we ended up losing both Bostons 3 weeks apart in March of 2020, literally right after lockdown started. So our pug puppy is, well, she's not a puppy anymore, but she is an only child. But yes, I love that dog.
So more to come if you want to support something close to Josh. There, it's pug rescue action. If you can rescue some of these dogs that are with very abusive owners, sad stuff that we've seen there. And then you guys there are with the catcher mitt to help out some of those situations. This is awesome stuff.
Yeah, Stella's not suffering by any means. She's got 2 dog beds just in this office alone.
Living the life, right?
Yeah. Every time she comes in here, she stares at her bed, which has a blanket on it, and she wants me to fluff the blanket before she actually gets in the bed. I'm not joking. This is real.
You bet you do it every time too. Like you're onto it.
Yeah, I mean, she's super cute. Come on. Of course I'm going to do it.
Oh my God, I love it. No, it's great. Yeah, we're running out of time. This is awesome. I hope this is helpful for folks to learn about. The story is interesting, incredibly interesting about where you come from, what you've in essence sacrificed to be where we are, and then the positioning that you've set Insight up for the long term. That's the next evolution. Is the next steps are going to be crazy. I would say the next decade is going to be kind of wild in terms of growth. So it all comes out of, man, like knocking on doors, right, and just pounding pavement and sacrificing there, and then being curious is kind of a run through here of like just not accepting answers as status quo, but searching for real solutions for clients, and that's what sort of sets Insight and us apart. I think.
Absolutely.
I love it.
Hey, thanks for hosting this today, buddy.
Yeah,
Appreciate it.
man. Guess what? You get to do it next time.
Oh, I'm going to take your role. I'm going to be the
Oh
host.
man,
It's going to be
okay.
awesome.
I'll try to answer questions next time well. So
I'm going to wear my beer helmet, and you're going to have to talk with a straight face the entire time.
oh boy. Yeah, okay. I would like to that done. I would like to see that. That'd be perfect. All right, we're cutting this off. If anyone's still listening at this point, I give you a lot of credit for sticking around to listen to this at this point. But thank you everyone for listening. So origin stories, we'll continue this and talk. I think 2 or maybe 3 more of these. Maybe one about me, and then thinking about like the next decade of the firm. I'd really love to talk about. So we'll get to it.
Absolutely.
So thank you, Josh, for sharing all this really great stuff, and thank you everybody for listening.